Hello everyone and welcome back. In today's video, I'm going to be reviewing a few mechanisms within DeFi that I thought were interesting, and this mainly has to do with automated market making, which in my understanding is a new function being introduced to our financial systems, as well as covering more specifically how automated market making is set to be implemented on the XRP ledger with the implementation of XLS30D. And all links to the information presented here will be available in the description below if you'd like to explore yourself further. And with this information, I don't necessarily have all of the dots connected, but still wanted to share some of this more technical info because I think it's relevant to understanding DeFi as a core piece of trusted global finance. So let's dig in. So what are automated market makers? Instead of relying on traditional buyers and sellers in a financial market, AMMs keep the DeFi ecosystem liquid 24/7 via liquidity pools. Automated market makers are part of the decentralized finance ecosystem. They allow digital assets to be traded in a permissionless and automatic way by using liquidity pools rather than a traditional market of buyers and sellers. AMM users supply liquidity pools with crypto tokens whose prices are determined by a constant mathematical formula. Liquidity pools can be optimized for different purposes and are proving to be an important instrument in the DeFi ecosystem. On a traditional exchange platform, buyers and sellers offer up different prices for an asset. When other users find a listed price to be acceptable, they execute a trade and that price becomes the asset's market price. Stocks, gold, real estate, and most other assets rely on the traditional market structure for trading. However, AMMs have a different approach to trading assets. With the addition of the XLS30 upgrade, which I will talk about more shortly, it is my understanding that tokenization solutions and decentralized exchanges such as Sologenic stand to benefit from XLS30 going live. For example, what is now a simulator for trading stocks, commodities, or ETFs may become enabled with real-world liquidity to facilitate trade. Recent research has shown the capabilities that AMMs unlock for liquidity providers. Two notable examples are replacing market makers and replicating monotonic payoffs. So in this case here, a company called Duality is talking about AMMs, and they're saying, while in their understanding of how best to engineer these derivatives is still nascent, building tools to make them more accessible and flexible has massive potential. These innovations enable liquid derivatives markets that don't require adversarial market makers, just a well-designed AMM position. Cutting-edge research is continuing to explore how AMMs can be used to enable future markets, expand space of payoffs by selling the right to arbitrage pools, invert payoffs through lending markets, use liquidity positions as staking derivatives, and more. So one of the most developed and ready to implement in a regulatory compliant manner for global liquidity is, in my opinion, the XRP ledger. And this abstract is describing the XLS30D implementation upgrade to the ledger. It says, the XRPL decentralized exchange currently provides liquidity exclusively by manual market making and order books, which also in my understanding is kind of the way it works in traditional financial systems currently. This proposal adds non-custodial automated market maker, AMM, as a native feature on the XRPL DEX in a way that provides increased returns to those who provide liquidity for the AMM and minimizes the risk of losses due to volatility. A key piece to me is non-custodial, referring to the fact that we'll be able to provide liquidity without having the assets leave our own custody. We propose a unique mechanism where the AMM instance continually auctions off trading advantages to arbitrageurs, charging them and giving these earnings to its liquidity providers. This allows liquidity providers to take a large share of the profits that would normally be taken by arbitrageurs. The AMM instance charge a spread on the trades that change the ratio of tokens in the instance's pool. This trading fee is added to the AMM instance's capital pool, thus adding to the liquidity provider's returns. The AMM instances also provide governance rights to the largest shareholders of the AMM instance. The payment and order placement transactions automatically determine whether swapping within a liquidity pool or through an order book will provide the best price for the user and execute accordingly. Also included in the introduction to XLS 30D on the GitHub from the XRP ledger, it says AMMs are agents that pool liquidity and make it available to traders according to a predetermined algorithm. This is a proposal for geometric mean market makers as a native XRPL feature. GM3 algorithmically discovers a fair exchange value stabilized by arbitrage to automatically produce liquidity. On XRP ledger, this would provide liquidity pools between XRP and issued assets as well as between any two issued assets. Arbitragers play a significant role in keeping the AMM DEX in a stable state with respect to external markets. Several things that contribute to the cost that trading imposes on AMM's pools are naturally much less significant on XRPL. We have low transaction fees, fast finality, and canonical transaction ordering. AMMs are more effective and lucrative when transactions execute quickly, cheaply, and fairly. This means that the XRPL AMM could provide more liquidity at lower prices, yet still provide a compelling return. I also had the pleasure to review this AMA that was happening in the XRPL Devs Discord channel, and I'd like to read you just a few highlights and screenshots of a couple of the responses that I thought were unique and valuable. So in this AMM ecosystem, we have liquidity providers who add liquidity to the AMM pools. We have traders who swap one asset for another for a fixed fee. We have developers who can integrate directly with the AMM DEX pools to power exciting interactions with tokens, trading interfaces, retail experience, etc. Each participant plays a role to build a thriving AMM ecosystem. While designing a protocol, we have made sure to take into account the motivation for each participant and to optimize it for all. XRPL has some natural advantages: fast finality, lower transaction costs, and fair transaction ordering that makes it well suited to support an AMM-based DEX. And a further elaboration, protocol native allows developers to utilize AMM functionality without having to create their own smart contracts and face associated risk, so that's more secure. Anytime I could take less counterparty risk, I definitely lean in that direction, personally. No front end or MEV. Inherited benefit from the XRPL's federated consensus. There are no miners to prioritize only higher gas fee orders. DEX integration. The proposal allows for the integration of CLOB and AMM on XRP ledger. This enables price optimization to determine whether swapping within a liquidity pool or through the order book provides the best price and executes accordingly. Single-sided liquidity provision. Anyone can easily participate as a liquidity provider. Only a single asset is required to contribute to a pool. The protocol swaps on an LP's behalf to maintain a 1-to-1 ratio, thus decreasing the number of steps for users and improves the user experience. So regarding the infamous secret sauce, let me start by defining the problem/friction point that we're trying to solve through the continuous auction mechanism. Impermanent loss, an inherent problem with AMMs. It happens when volatility or asymmetric trading causes relative price of assets in AMM pools to go out of sync with that of external markets. And an AMM does not adjust the prices automatically due to lack of external market information. As a result, arbitragers intervene, but they have to wait until the profit from the transaction exceeds the trading fees, race/compete against others who are also trying to arbitrage, which results in a decreased trading volume and hence a loss to the pool and the liquidity providers because of low trading activity. And second, when the arbitragers trade to the balance of the two markets, they make profits at the expense of the pool. With the CMM, we tried to create a mechanism that is profitable for both the arbitragers and the LPs. AMM continuously sells off trading advantages for 24-hour periods at near zero trading fees, and proceeds from the auction are divided between previous slot holder and the AMM pool. As a result, this eliminates wait time and race condition for auction slot holder arbitrageurs, thus reducing the periods of reduced trading activity, reduces the impact of impermanent loss for liquidity providers, and liquidity providers reap a share of the profits that would otherwise just be to arbitrageurs. A win-win. So thanks for tuning in. I hope some of this information can be useful to you. Like I mentioned, I'm not a blockchain expert, but nonetheless wanted to share some of this info that I personally found interesting. And I may not necessarily have all the dots connected, but nonetheless wanted to share. So thank you again for watching, and have a great day.